Well, hi guys, welcome to another Ultimate Edge webinar and welcome to my co-moderator, Marcia Murphy. Hi, Marcia. Thanks for joining me today.
You're welcome. I'm looking forward to this.
Do you know what we're going to talk about today, Marcia?
Well, the title of your presentation was kind of a hint, something about soft money.
Absolutely. We're going to talk about soft money. I'm going to pop it over, guys, to a presentation in just a minute here. But first of all, I just wanted to welcome you all. If you're on a YouTube audience, thanks for joining us. Make a great thumbs up and like and all that kind of stuff. And if you're in the webinar audience, there's a chat box there. Use that for any questions that you might have. We'll pause occasionally. Marcia and I will try to monitor. Brittany, our marketing person, will probably be monitoring and let us know as well. So with that, let's dive in, Marcia. What the heck is soft money anyway? Let's see if
that is a great question, John. Maybe you could kind of enlighten us.
I only ask great questions, Marcia. You know that.
Oh, okay.
All right. So, guys, I'm with Bay Equity as well as Marcia. Marcia is the, well, maybe smarter of the two. We co-run a branch together. She's in Hawaii, and I'm typically in Washington State, but sometimes in Hawaii and all around the place. So there's our stuff. We're going to talk today about soft money, and it's a term that we've coined for funds that's alternative funding for loans for people who are looking for loans. And I call it soft because it's in between hard money and conventional loans. And as we go through this and point out some of the examples of soft money, I think you'll probably understand. There are actually lots of kinds of soft money in this arena. This is the non-QM arena, if you understand that. And we actually have a webinar which is on our YouTube channel for 11 different kinds of loans that you can use for the self-employed borrower. Soft money works really well for people who are self-employed and cannot verify income in the normal manner. Today, we're going to focus on 3 of them, Marcia. We're going to do the DSCR loan. We're going to talk about bank statement loans. And we're talking about no ratio loans because those are primarily the 3 most popular loans that we get requests for from self-employed borrowers. Let's go.
Okay, now, John, before you dig into this, can you define what you mean by non-QM?
Let's make it simple. Non-QM is a designation put up by the CFPB, Consumer Finance Protection Bureau, that defines loans that are basically not conventional loans. So not Fannie Mae and not Freddie Mac. They typically are non-QM loans because we verify income in a different manner. Sometimes we'll allow higher debt to income ratio, and sometimes they'll have a prepayment penalty. All of those things would take it out of the Fannie Mae, Freddie Mac arena and into another arena called non-QM, which stands for non-qualified mortgage, unlike conventional, which is a qualified mortgage. You want to add to that, Marcia?
Yeah, that was very good. Thank you.
All right. Thanks so much. Okay, DSCR loans. You may have heard that acronym, guys. It stands for Debt Service Coverage Ratio Loan, but that's too hard for me to say, so I call it the simple loan. And it is simple. You're going to like it if you like simplicity here. So what's a DSCR loan? It's a loan on a residential property, which single family to fourplex. And actually, this is an older slide because we can go up to, I think, 8 or 10 units now with the DSCR loan, with the classic DSCR loan. We use just the income on the property as the qualifying income for the loan. That's a good thing if you don't have any other income, right? So understand, it's non-owner occupied only. This is not an owner occupied loan because you must have income on the property to help qualify for the loan. And what we do is we take the total monthly income on the property, and let's say it's $3,000 a month, and we look at the total mortgage payment, which is principal, interest, tax, and insurance. If there's HOA dues, they're in there. And we would want the mortgage payment to be less than, no greater than, the income on the property. If it's exactly equal, it has that 1-to-1 ratio that you see there. And if it's less than that, we like it. And if it's more than that, well, we can do it when the mortgage payment is actually greater, or the rental income in this case is actually less than the mortgage payment, but there are restrictions. We're going to lower the loan to value. We're going to increase the interest rate, and you're not going to like the loan as well as if you can get the 1-to-1 ratio. What do you think, Marcia? Does that cover it pretty well from a a description of a DSCR loan?
I think that does cover it, just to be clear. So you're not going to look at any other documents from the borrower, other for income or qualifying. Is that accurate?
Marcia, it's funny you should say that. I don't know if it's on the next slide. I'm going to answer that question on the slide after this one.
Oh, here we
okay?
go.
That's
Okay.
a very good question. So why is it the simple loan? This kind of answers that. We're not going to get any W-2s from you, no pay stubs. If you're self-employed, we're not going to get tax returns. We're not even going to get lease agreements in many cases. If it's a purchase scenario, you don't even need to have anybody in the property if you're buying it. We're going to ask the appraiser to tell us what the market rent is, and we're going to use that number to figure out what the rent is on property. Now, if you do have somebody in there, we're going to get the lease agreement for that, but no lease agreements there. If you have other properties, we're not going to get any of those lease agreements. We're only focused on the subject property. And then note there that if you decide you want to refinance, and a lot of our clients do, they refinance with this loan, and you own the property because you're refinancing, then you must have somebody renting the property at that time, and we're going to get the lease agreement for only the subject property, no other properties that you own. No K1s. If you are an S Corp or you're an LLC, you know what K1s are. That's business tax returns. We're not going to get those, and we're not going to get tax returns. How's that for simple, Marcia? What do you think?
I think that's amazing. Very simple.
Yeah.
So the income, we just want the income to basically cover the mortgage, taxes, and insurance on the property. Is that correct?
That's it. That doesn't get any more simple than that, does it? I mean, I could have stopped the webinar right there because that's it. But let me show you something. It's kind of cool. Okay, so no other income is stated on the loan application other than the income on the subject property. That's it. Let's compare. So this is a synopsis, a summary of a borrower, Donald and Daisy Duck in this particular case, and they're using income to qualify for the loan. And when they fill out the loan application, Marcia, that's what it could look like. You can see that Donnie works for Mickey's Dog Trainers, and he has base income there. I don't know if my little mouse can show you this. And he has overtime income, and he has bonus income. And Minnie's over here working for Minnie's Duck Dodger, and she has some base income and some commission income. So all that income needs to be put in the right slots. And guess what? Once it's there, we need to verify it. So now we're going to get 2-year history or maybe just W-2s. But if you have overtime and you have bonuses and commissions and that stuff, we're going to get a verification of employment from your employer. It's a lot more paperwork. Let's say that Don and Daisy decided to purchase a property as an investment property and use the DSCR loan instead. So their next loan application would look like that for income. Does that kind of clarify it, Marcia? We're not getting any other income.
That's pretty clear, John. Yeah, I don't see any income.
There's none there. I did those 2 slides on a presentation to a live group of investors one time, and someone came up at the end and said, man, did that strike home with me? Those 2 slides that you used. It's really that simple. I mean, it's so much easier for our borrowers. Okay, there's probably a reason for that, right? We're going to get to that. So each property stands on its own. You probably know that now from our conversation. We don't get income from other properties. Look at just the subject property. There's no limit to the number of properties you can own. Is that kind of cool, Marcia?
That is very cool for all those investors out there that just keep buying. That's unusual, actually.
Yeah. As a matter of fact, Fannie Mae and Freddie Mac can eventually say, sorry, we're not going to give any more loans because you own too many properties. I believe the number is over 10 now with Fannie, so that's a lot, but I have investors that are there. The minimum down payment is 15%. On a purchase scenario, I have yet to do one of those. And the reason is because when you put 15% down, you're going to see that the interest rate is higher. I'm going to show you some parameters on rates here in a second. And the loan is higher. And so it's so much more difficult to make it debt service, the debt service coverage ratio, right? And if it doesn't debt service, they're not going to allow you to put 15% down. It says that. I have yet to do one. Rates. This is kind of cool, Marcia. The rates on the DSCR loan are dependent on a number of things. Credit score. So a higher credit score gives you a lower rate for the very same loan. Loan to value. So the very same loan with the very same borrower with the very same credit score, if you're at 80% loan to value, you're going to get a higher interest rate on that very same loan than if you're at 75% loan to value. And if you get down to 65% loan to value, you're going to see the rates on these loans are very competitive, even with conventional financing. Rates depend on the number of units. So single family has lower rates typically than a fourplex. They depend on the size of the loan. They depend on the type of income. That LTR is long-term rental income versus short-term rental income. Yes, we can do short-term rental income. Marcia loves that. She lives in Hawaii, remember? And we use short-term rental income over there a fair amount. Depends on the property location. Some lenders won't even do rural, some will, but the rates are higher. Depends on the interest only versus amortized payments. There's a lot of variables on rates, guys, and it's one of the things we're going to strategize with you as much as anything. Any comments, Marcia, on just that?
No, I think that's pretty clear. Is there loan amount limits? Like, can we go to like 2 million or?
There are loan amount limits, and I think it's for somewhere around between 2 and 3 million. So it's a chunk. There's also a minimum loan, which is basically with most of our investors $100,000. So a buddy of mine is buying a home in Ohio, and he came to me and said, "Can you do this loan?" I said, "Well, the first problem is it's in Ohio, and the purchase price was 70 some thousand, and you got to put 20% down." So I couldn't even do the loan because the loan amount is too small. Having said that, seller carrybacks are allowed. There is some flexibility there, and that's a cool thing, Marcia, because if you put 20% down, let's say, and then you talk the seller into carrying back 10%, our loan is only going to be 70% of the purchase price instead of 80% without the seller carryback. And because the loan is at 70% loan to value, not 80, the interest rate is better on the mortgage that we're getting from us. So a little strategy there that could help you out to get lower payments on your loan as well. How cool is that? I mentioned there's no tenant required on a purchase, so that's kind of cool as well. Refinances, you want to be aware. The BRRRR strategy, remember what the BRRRR strategy is, Marcia?
Sounds like it's a cold strategy to me.
That was very
That's about
clever
as
of you.
creative as I can get. So
I can see that you
enlighten us,
haven't been,
please.
you have not been on your Bigger Pockets webinar
Oh, yeah,
or
the bigger
podcast
pockets.
recently.
All
I
right.
can see that. It was pocketed by, I can't remember his name, the guy at Bigger Pockets. It stands for repairing or buy the fixture of properties that you buy, you repair, you refinance once it's repaired, and you repeat. BRRRR. Buy, repair, refinance, repeat. So you keep the property when you refinance it. And this loan works wonderfully well. A lot of our investors who do fix and flips, BRRRR strategy things, don't have the income on the tax return because they cover it up to qualify for a loan on a refinance with a conventional loan. So they use the DSCR loan. They buy the property, fix it up, get the extra value there, and then refinance it with the DSCR loan. I want to emphasize there are seasoning issues there. If you decide you want to pull cash out on your refinance, which is above and beyond what you owe on the property, you typically need to own the property for 6 months to a year, depending on the investor we go to. But if you do what's called a rate and term refinance, which means you pay off just the mortgages on the property, there's no seasoning, Marcia. How cool is that? You get done with your 3 months rehab, property's worth twice as much. We can use that increased value for refinance, which helps you on the loan to value. What do you think?
I am blown away. That is amazing.
Well, when you get into the numbers and you want your money back, strategy really matters, and understanding these limitations or how to deal with them, guys, is a better way to put that, can get you your money back because we're going to treat it like a rate and term. And if we'll talk about that specifically with you if you want to understand how that works. But it's important to understand those parameters and understand you need a tenant in the property with a lease agreement. And something I wanted to mention here. Oftentimes our investors will do a lease option, or they'll find someone who wants to lease this beautiful brand new property they just fixed up for higher than what the market rent is. Remember, I said we were going to look at the appraisal. We're going to ask the appraiser to tell us what the market rent is. So if you decide you want to refinance and use a higher lease income, you need to have a minimum of 2 and sometimes 3 months of history on the higher lease income paid to you in a really clear manner. So what I'm suggesting is you have a bank account set up for your property, just like smart investors do. And then when they pay the lease income, the tenant pays you your rental income, you track that very carefully into that bank account so we can see the higher rental income for 2 or maybe 3 months. At which time we can then use the higher rental income and you qualify for more DSCR loan. So underlying theme here is strategy really matters. You need to understand the ins and outs of the loan. Any thoughts there, Marcia?
Well, I think, what really is standing out to me is on a refi, I can buy that fixer-upper and put a bunch of money into it to bring it to, good condition, rentable condition, and then I can get my money back out of that with this loan, John, and that's considered a rate and term.
If you do it properly. And what that means is
Okay,
you
well,
need to have a first and maybe a second mortgage in place for those funds that you put in there. So we got to do it in the right manner when you buy it. It's important to talk to us first. But yes, okay. If you don't do it in the right manner and you want to get your money out and you can't verify your funds and all of that, then you're going to have to wait 6 months to a year. And some of my investors do that. They wait a year and then they refinance out of that hard money loan then and they move forward to the next one.
Okay. Good
Okay,
information,
cool.
John. I love this loan.
Yeah,
It
it's a
is
great one.
simple.
Yeah,
Now,
it is,
here's the
but
question. Is it easy?
it's easy if it's set up in the right manner. It's hard and a pain in the rear end if it's not set up in the correct manner. So what I mean by that is, let's say you bought that fixer-upper, you fix it up, and now you want to get your money back, and you come to us and say, okay, I want to get all my money back. And you say, well, that's a problem because now it's cash out, you need some seasoning, and you go, oh my goodness, and that doesn't work so well. But if you get it set up fine in the right manner, it's a very easy loan. If you've owned the property for greater than a year, and lots of times that's the case, then it's really, really easy because you've seasoned it then and you can do cash out and you can get your funds back. So yeah, it's typically pretty easy, especially once you know the loan. All
Very
right.
good information.
Good. Brittany, I can't see any comments because of my screen. So if you can look at them and if you see that somebody's asking a question, let us know that. You can interrupt our conversation here and we'll move forward.
There are
All
no
right,
questions
so
at this time.
okay, thanks. We're going to show you a quick calculation, guys, to see how simple this is. You purchase the house and the purchase price is $550, the rent's $3,700. You're going to put 20% down, so you're going to get an 80% loan to value loan. That's an approximate rate for you and your credit score, 8.375. Yes, that's a higher rate than what a conventional rate is, no doubt about it. I'm going to show you ways that you can reduce that in a minute here. But let's say under this circumstance, that's what it is. So your total payment is $3,874. The rental income on the property is $3,700. And we do the calculation. We divide the rental income by the mortgage payment. It's less than 1. That's a problem, Marcia. We are very strict about the greater than 1. There's a couple of solutions, however. I bet you're wondering what they are.
How about if you get cheaper insurance?
That's a great one. What if you can't?
Okay.
Okay, one is you live with that because, as I mentioned, we can do debt ratios, debt service coverage ratios less than 1. But there are 2 things that happen. Oftentimes, the loan to value gets decreased. So you may not be able to put 20% down. You got to put more down because the debt ratio is less than 1. And certainly the interest rate is going to be higher because it's a riskier loan from the lender's perspective. So instead, you couldn't find the insurance. Marcia looked and the insurance was what it was. So you need some other solution here. Same purchase price, same down payment, and you do an interest-only payment. Notice the rate there is 8.625%. I don't know if you remember or not, but the rate on the previous one was 8.375. So the rate here is higher because it's an interest-only payment loan. However, interest-only payment causes the payment, the overall payment, to be lower. So when we do the debt service calculation coverage, it's over one, voila, it works. You get 20% down. You do have a slightly higher rate, but it's not that bad. And your overall payment's less. Well, that works.
Magical, John. So the investors, they qualify you with the interest only payment then.
That's exactly right. They qualify you
Wow,
with the
that's
interest-only payment. I don't
very
think it's quite
unique.
magical, but thanks, Marcia. But it is a good strategy. But here's
And
something
I
recent that
think Wendy had a question. I didn't quite see it.
Brittany, any question from Wendy?
I'll check it out, or
All right,
Brittany
check it out for
can.
me.
Okay.
Okay, I'm glad you can see them. I can't. So very recently, like last week, one of my investors sent me an email that says they can now use liquid assets to supplement income on the DSCR loan. So there's another possible solution. Let's say you have a stock account that's got 500,000 in it, and you're not going to use that for the purchase. So it's part of your reserves. There's a calculation, we call it asset depletion in the mortgage industry, where we'll anticipate a certain amount of payment income off your liquid assets. You don't actually have to take the income. You don't have to liquidate anything. We just know that the liquid assets are there and they're available. So you could, and we'll do a calculation on that and we'll add that income to the DSCR income and we could fix the problem in that way as well. So I wanted to bring that up because it's very recent and I just thought I'd throw it in there. Pretty cool.
So John, I think that Wendy was just wondering, maybe she was thinking that her question is, we don't require a 1.25 ratio.
That's a great question, Wendy. We don't require a 1.25 ratio. That's an experienced investor talking, coming from the multifamily world, when we do require 1.25 ratios in some cases. And if you have a 1.25 ratio in this world with the DSCR, which is residential, the rate is sometimes better because the ratio is improved. So yeah, don't require it, but it can sure help you out. Good question.
Thank you.
All right. Now that's over half the webinar there because we spent some time in the DSCR. I did that on purpose, guys. The DSCR loan is by far the most common used loan of the 11 loans that we talked about earlier in our webinar. The second one is bank statement loans, okay? And I call it maybe the not so simple loan, but it really works when you need it. And you need it when you're self-employed and your tax returns don't work, and so you use bank statements. This is much quicker. I'm going to go through it for you so you understand how it works. We can use either business or personal bank statements. We're going to use 100% of the deposits on the personal bank statements, but keep in mind, we're not going to take any transfers. So when you're looking at your bank statements and you go, oh my goodness, look at all these deposits, there's $50,000 worth every month. But most of those are transfers. We're going to deduct those from that. That's the biggest reason people have problems with bank statement loans, because of lots of transfers. We don't do that because you can transfer from one account to another account of your accounts and it starts double counting deposits, right? So we just take them out. And if it's business bank statements we use, we will typically use 50% of the deposits because we know it's a business. So we think that there's an expense factor associated with your business. If you can't show us what the expense factor is, and most people have a difficult time with that, we're simply going to use half the deposits as your qualifying income. If you do have a lower expense factor and you have a CPA who's willing to write on their letterhead, Marcia's business really has an expense factor typically of 20%, which means 20% of her deposits go to expenses to run the business. We will use the rest, which is 80% of the deposits in that case, as qualifying income for the loan. So that's one way you can qualify for more loan. And I don't know if it's in here. Oh, multiple business bank statements are allowed. So if you have two businesses and you're running a bunch of deposits through one and a bunch of deposits to the other, we can separate those out and see the deposits are related to each business, then we can take two businesses and add them together potentially and use that for qualifying income. And if you have W-2 income, it's allowed. So let's say you have two people applying for the loan, they're married, The wife has a self-employed business. We use bank statements for her because she writes everything off on her taxes and her net tax return doesn't show a lot of income. The husband is W-2. We can take his W-2 income, add it to her bank statement income, and you can potentially qualify for a loan that way. So that's pretty cool sometimes. I think that's the last one. Oh, single family residence to fourplex and no prepayment penalty on any owner occupied loans. So it doesn't say there, and I probably get to it later, but I want to make something really clear here. When we're using bank statement loans, we get a minimum of 12 months of bank statements, guys. And you could get 24 months if it helps improve the picture. So it's the most recent bank statements, and it's usually the most recent 12 months, and we're going to add them all those deposits together, kick out transfers, divide by 12, and that's your monthly qualifying income with this particular loan. Any comments, Marcia?
Yeah, I do have a comment on this. I'm seeing a lot more of these type loan requests. And that I worked with several clients that the rates are a little higher than the Fannie Freddie world, but I've had clients, like, well, can we go the Fannie Freddie world, Marcia? And the answer is, well, yeah, if you want to change the way you do your tax returns and show your income, and basically, pay, you end up paying taxes to the IRS, or you can end up getting this kind of loan. So typically 9 times out of 10, they're like, you know what? I like this bank statement loan.
Yeah, almost 9.9 times out of 10. That's exactly right.
It's a great product.
It's a really nice product for people who are self-employed. Self-employed borrowers only on this, okay? Keep that in mind. So you want the really simple loan? It's called the no ratio loan. And as you might imagine, it's really, really simple because we don't get any income on the loan application. No rental income, no nada, okay? It's a no ratio loan. If we don't have income, we can't compute the debt to income ratio. So it's a no ratio loan. No income on the application. It takes a much higher down payment. It's 30% minimum, and that changes. I really should state here that all the parameters I'm talking about on all of these loans could change overnight with our investors. It's a very fluid industry. So they could be improvements and there could be some concessions. And I see that minimum is spelled wrong on the screen, but that I just noticed that. But that just goes to show you that things can change, even the minimum. You do single family or fourplexes with a no ratio loan. It is non-owner occupied only. You're not going to do an owner occupied loan in no ratio. It doesn't happen. And it requires a prepayment penalty. You can get a DSCR loan without a prepayment penalty. Most people don't because you're going to keep the loan for 1, 2, or 3 years. You're almost certain of that. And if you take a prepayment penalty on a loan for that period of time, it could be from anywhere from 1 to 5 years, then the rate's going to be lower for the duration of the loan. These are all pretty much 30-year fixed rates on these loans. We don't do much variable anymore because they're just not competitive. So it is a 30-year fixed rate on all of these loans we're talking about. And there will be a prepay in almost all non-owner, and it's up to you to determine how much time you want for the prepay. You can take 1 year, 2, all the way up to 5. You'll see the rate is lower the longer the prepayment period is in there. And we're going to show you that, and you're going to figure out what works for you. Okay. Owner occupied loans, no matter what kind they are, do not have any prepayment penalty. That violates the CFPB guidelines on it. So there you go. Comments, Marcia? Anything else I missed on that?
Well, this is almost too good to be true, really. No, you don't have to have any income. Now, John, what do the rates look like on a loan like this?
Oh, Marcia, it's so interesting that you should ask that question. Let's take a look. And she hasn't even seen the slides, guys. I want you to know that, all right? Let's compare these loans, okay? So here's a matrix. You can see that there's 3 loans across the top there, the DSCR, and then the bank statement loan and no ratio, the properties. So as I updated on my conversation on the DSCR loan, we can go up to 8 or 10 units depending on the investor. single family all the way up to units, and we can do condos. The bank statement loan is a residential loan, so we stick in the residential arena in terms of number of units, single family to 4 units, and the no ratio is single family to 4 units or condos. Marcia doesn't care about this because she lives in Hawaii, you might remember, but on the mainland, you care a lot. We do not do manufactured homes on any of these loans. So if you're an investor and you want to buy the manufactured home with the shop and do something, you're not going to use this loan. You're going to use a different kind of loan. Actually, if you're an investor and you're buying manufactured homes, it's pretty thin pickings for loans because Fannie Freddie's not going to do investor loan either. But if you're owner occupied, you're fine. I want to differentiate that for you guys. Occupancy, you can see DSCR is non-owner only. Bank statements, you can do owner occupied or non-owner occupied, and no ratio is non-owner. So let's start with that. And here's some rates. Imagine that. So the maximum loan to value on DSCR is 80 to 85%. I priced it just today with an 80% loan because 85% never works. So that price that you see there in the DSCR is an 80% loan. The interest rate is 7.5% on a 30-year fixed loan. The APR is that. And I might have, that's a 3-year prepayment penalty with that rate for the DSCR. Notice the bank statement loan, the rate's higher, but the reason is because you're at 90% loan to value on maximum loan for the bank. So that's a 90% loan. You're getting a 9% rate, and that sounds really high because it is, but there's no mortgage insurance on this loan, which makes a lot of difference in the payment. If you were doing a 90% conventional loan, owner occupied, your rate would be lower, considerably lower, but you'd have MI in there, which makes up some of the difference on that. All right. And then on the no ratio loan, I couldn't get pricing today. You're probably in the 9.5%, 10% range on a no ratio loan. You pay for the privilege of no income there. Comments on that, Marcia?
Well, on the, just for clarification purposes, John, on that bank statement loan, 10% down, 9%, is that for an investment property or is that owner occupied?
Yeah, good clarification. That's owner occupied. You're not going to do anything greater than 80% loan to value for an investment property on that loan either. And I've compared, and the DSCR loan is comparable to bank statements, sometimes even better, because I think the investors like them. So if you're going to buy investment properties, you're going to do DSCR. You're not going to do bank statements. As long as the DSCR works. There is that.
And John, Miss Wendy does have another question for you. Are these loans available for a trust? Can you purchase, like specifically maybe with the DSCR, any of them, can you purchase and close in your trust?
Randy, I think the answer is yes, but let me qualify that, okay? We can certainly do these loans in entities. Matter of fact, some of our investors prefer that you buy the property in an LLC instead of in your personal name. And because they're in entities, I suspect the trust is acceptable, but I'd have to double check with the investor to know for sure. Good question. Wendy, if you send me an email, if it's the Wendy, I think it is, send me an email and ask that question. I'll double check that and I'll reply to your email. Any other questions, Marcia?
No, I think you've been, now, John, that rate on that bank statement loan, I know if they put more money down, it's much better than that.
Well, Marcia, it's funny you should say that, okay? Let's compare apples to apples here. So the bottom one there is a 70% loan comparing those two together. So notice that it's a 3-year prepay on the DSCR and the rate came down from 80%. It was 7.5. It's 7.125% with a 70% loan to value. So you put 30% down. And notice how much it drops on the owner-occupied bank statement. So that's an owner-occupied loan. The borrower's putting 30% down, 70% loan to value. The rate goes from 9 to 7. That is almost comparable with conventional rates. It's a little higher, I get it. But there's no prepayment penalty, and it's a bank statement loan. You don't have to go through all the taxes.
Well, that rate on that DSCR looks better than a current saleable rate today.
Yeah, it is. But
For
there's a
investors,
3-year
so.
prepayment penalty, guys. So
Oh,
You know,
Okay,
Marcia's
gotcha.
recognizing that, but remember, Fannie, Freddie on your investment property loans does not have any prepay. These loans do, but you could choose. You can say, I don't want to prepay, and you're going to see that rate increases a lot. You're probably going to say, well, maybe a 1 year or 2 year prepay. I'm going to keep it that long anyway. So there's your rates, guys. And there's our contact information. Oh, Marcia, I didn't have your NMLS number handy, so I didn't put it in there, but there's Marcia's contact info and mine as well. If you have any questions, certainly reach out to us. We're going to stop sharing here and come back so we can see our smiling faces. Marcia, any comments, any thoughts, anything I missed here?
Well, John, I think you did an outstanding job. These are, as I mentioned earlier, gaining popularity, just, in bounds, leaps and bounds. And I do see another question here from John and Shanna. Can you do a DSCR loan from a self-directed IRA?
I used to be able to do that, John and Shannon. I don't think I can now. I think the investor that I did that with pulled that product, but maybe, okay. Self-directed IRAs are normally serviced by North American Mortgage, I think is their name. We used to be able to broker to them, but then they stopped their broker thing. So I would direct you to them. I think it's North American Funding. And might be a little off because I haven't talked to them for quite some time. It's probably going to come back into our world, but I don't think it's there right now.
Okay. But you can double check on that, John, maybe.
Yep. Send me an email to that email address you saw. I don't know if you got it down. It's jmurphy@bayeq.com. If you or text me 206-499-5626, and that will remind me to follow up and get back to you on any of your questions.
Excellent.
Thanks, guys, for attending. Marcia, thanks for co-hosting with me today. Appreciate it so much.
All right. Thank you.
All right. See you guys.
Bye.